Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
Common sense isn't that common. If it were, we'd just call it sense. The older I get, the more I understand why ancient philosophers spent so much time staring at walls. We all want honesty, just not the kind that arrives without a warning label. Historic decision, they say that every week. History must be exhausted, work-life balance, checking email from a different chair.
US January payrolls came in hot. Unemployment dipped to 4.3% and suddenly the soft landing crowd found its voice again. But here's the catch. Hefty downward revisions show 2025 job growth averaged at just 15,000 a month. That's less boom, more background noise. So while GDP looks muscular, the labor market is quietly stretching before a nap. Traders noticed. June rate cut odds were sliced from 70% to under 50% faster than you can say data dependent. The Fed now faces a familiar dilemma. Strong headline, softer foundation. Capital is packing its bags. After years of treating the US market like the only restaurant in town, investors are finally reading the international menu. ETF flows into global markets are surging, while year-to-date returns show places like Korea, Japan and broader emerging markets quietly outperforming the S&P 500. Why the shift? US valuations look stretched, tech dominance feels crowded, and fiscal stimulus abroad, from Japan to Europe's defense boom, is offering fresher growth stories. This isn't a US collapse story, it's a rotation. When one table gets too expensive, investors try the buffet. As Yogi Berra said, when you come to a fork in the road, take it. Look at that surge. Asia's goods surplus has exploded to record highs, driven overwhelmingly by China, with Taiwan, Korea and Vietnam adding fuel. Meanwhile, Europe's goods balance took a dramatic dive in 2022 before stabilizing. Energy shock meets reality check. The message? Global demand hasn't vanished, it's been rerouted. Manufacturing gravity is leaning east, and those surpluses mean persistent capital flows, currency pressure and geopolitical tension wrapped in one tidy trade imbalance. For markets, this isn't just trade data, it's liquidity, FX strategy and rate differential in disguise. Rupees 4.6 lakh crores. Gone in 3 weeks. India's IT sector just had its existential crisis moment. The Nifty IT index is down 11%, with heavyweights like TCS, Infosys and Wipro flirting with 52-week lows. What's spooking investors? Generative AI automation fears, bold claims about faster enterprise migrations, and the uncomfortable thought that billing hours may shrink before new AI revenues scale up. Add FII outflows and a weaker rupee and the sell-off gains momentum. This isn't an earnings collapse, it's valuation compression meeting technological anxiety. On paper, US trade does not look dramatic. Exports up 6.3%, imports up 5.8%. The deficit widens modestly to about $956 billion. Services surplus improves. If you just read the table, you would think that the trade war RSVP'd, maybe. But supply chains don't pivot overnight. Tariffs distort incentives slowly, rerouting sourcing, reshaping manufacturing hubs, and quietly raising costs before it shows up in the headline data. Today's numbers reflect yesterday's contracts. Real shifts are happening beneath the surface, in capex plans, shipping routes, and geopolitical strategy. Here's the irony. The cure for high commodity prices is high commodity prices. Gold surged and jewellery demand collapsed. In 2025, fabrication demand fell to just 1,638 tons, barely 33% of the total 5,002 ton supply. That's one of the weakest jewellery seasons in over 2 decades. When half your traditional demand base steps aside, price becomes its own suppressant. Consumers blinked, investors did not. Central banks stayed active, but retail jewellery, historically 50% of annual demand, simply couldn't keep up with elevated prices.